we have Agree Realty Corporation. Now, this is another real estate investment trust, and it's actually kind of known as the little brother of Realty Income. Now, if we look at the past year, this REIT's absolutely killed it. They're up over 25%, currently trading at about $73 per share. And if we go ahead and look at the starting dividend yield for this one, come up here and plug in ADC. What we can see is, again, a high starting dividend yield sitting at about 4.11%. Again, dividends paid on a monthly basis, of course. Now, here's what a lot of people like about ADC. If we jump over to their investors presentation, it's their tenants. Look at the top tenants for ADC. These are large, stable companies that likely aren't going away anytime soon. And if we take a look at the top retail sectors right here, we can see grocery stores make up about 9.4% of their annualized rent, home improvement 9.3%, tire and auto services about 8.3%. What I'm trying to point out is this is a pretty well diversified tenant base for ADC. But here's what I also love. We can see 68% of their portfolio, of their tenants, are considered investment grade. Again, I've said it before, but a REIT is only as good as the tenants that it holds in its portfolio. So if the health of the tenants is strong, then the health of the REIT is likely strong as well. Now, if we come down even further in the investor's presentation, here's what's impressive. They have a growing, well-covered monthly dividend. They have 154 consecutive common dividends paid, and the average AFFO payout ratio is about 76% over the last 10 years, which is pretty much in line with what we just saw with Realty Income. But we can see that dividend over the past decade has grown at about 6% for their 10-year compounded annual growth rate. That is phenomenal dividend growth for a real estate investment trust. It's rare you can find an investment growing their dividend that fast that also has a starting dividend yield above 4%. So what is it that's allowed them to grow their dividend at that high of a rate? Well, if we jump back over to Seeking Alpha, let's dig into those financial statements just a little bit. What I want to do is look at the income statement. And again, when we're talking about REITs, we don't want to pay attention to earnings per share. We want to pay attention to adjusted funds from operation. And that's what we have right here. We can see this is obviously growing, but one of the things we also have to remember is REITs are constantly diluting their shareholders for the reasons that I mentioned earlier. The only two ways to raise capital is to take on new debt or issue new shares. So we can't just look at adjusted funds from operation. We want to look at adjusted funds from operation on a per share basis. It's important to remember that. So let's keep scrolling down. Right here, we have adjusted funds from operations on a per share basis. Look at the growth we're seeing over the past decade. They're growing AFFO per share at a much higher rate than we've seen from most REITs over the past decade. And so as a result, they've been growing their dividend payments at a higher rate as well. Now, if we look at ADC from a valuation perspective, assuming about 4% dividend growth and a discount rate of 8.5%, we come to an intrinsic value of about $69.33, which is about 5% away from the current share price. So with the huge run up in the past year, up about 25%, they do trade at a slight premium, but for the most part, it looks like this company is fairly valued, so add it to your watch list so you're prepared for opportunities. And then lastly, we have a covered call ETF, SPYI, the NEOS S&P 500 High Income ETF, currently trading at $51.88 per share, and over the past year, it's up about 5.34%. Now, there's a lot you have to understand about covered call ETFs and how they operate to understand if it fits into your portfolio. And there's so many different covered call ETFs and they each have different strategies. But let's talk about the pros and cons of this one specifically. Now, to start off, let's go ahead and look at the dividend history for this covered call ETF. Now, obviously, it doesn't have a long history because it's a relatively new fund. But the first thing we'll notice is, yes, the payments fluctuate a little bit, but not very much for a covered call ETF. For example, let's compare it to another popular covered call ETF like JEPI. If we plug in JEPI here on Seeking Alpha, we can see the dividend payouts fluctuate by a large amount. For example, look at the low right here. It had a dividend payment that's about 29 cents last year, it looks like in July, and at its high, looks like it had a dividend payment that's about 62 cents. So we typically see massive fluctuations in the payouts from covered call ETFs. But that's not typically the case as much for SPYI as we've seen so far. For me personally, I'd consider that a plus. Now, one of the things I also want to point out when we're talking about covered call ETF, look right here. They had a bigger dividend payment in August of 2024, bigger than the typical payment. Why is this? Well, we have to remember when it comes to covered call ETFs, volatility impacts their performance. These funds sell covered calls and collect premiums that they pay out as dividends. And the amount of premium they collect depends on market volatility. Higher volatility typically leads to higher premiums and larger payouts, while lower volatility does the opposite. Now, one of the things we also have to remember about covered call ETFs is they have a capped upside potential. Selling call options caps the upside potential of the underlying stocks as gains are limited to the strike price of the options. And for example, let's look at QYLD, another popular covered call ETF. They write call options on 100% of their portfolio, which really limits their upside. So for example, if we look at the past 5 years, they're down by about 22.6%. So yes, they pay out a big dividend, but we don't want to see a reduction in the original value of our investment. But this is where SPYI is different. SPYI doesn't write covered call options on 100% of their portfolio. It's typically going to be closer to around 80%. What this means is it allows the share price to move more freely with the markets, giving them more upside potential. And we've seen that happen over the past year. They're up about 5.34%. So obviously didn't rise as much as the market, but they did get to take part in the rise of the market. Now, when we look at the starting dividend yield for SPYI, it's very large, sitting at 11.88%. And in fact, if we jump over to their website, we can see their target distribution rate right now, about 12.01%. But the other thing we have to make note of is they have a large expense ratio because this is an actively managed fund because the fund managers are the ones writing the covered calls. The expense ratio sitting at about 0.68%. So yes, that is a large amount, but if you account for that in the distribution rate, you're still getting above an 11% yield. So big dividend payments on a monthly basis, it's easy to see why people are attracted to this fund. But the last thing I want to point out about this fund is it's more tax efficient than a lot of its covered call peers. Why is this? Well, if we take a closer look at the fact sheet, look at the tax efficiency. SPYI utilizes SPX index options classified as Section 1256 contracts. Why is that important? Well, 1256 contracts are taxed at 60% long-term capital gains and 40% short-term capital gains. So what does that mean? Well, here's what we have to understand. Here's the 2024 short-term capital gains tax rates. You can see you immediately, regardless of your filing status, start getting taxed on any of the gains that you see, starting at about 10%. So for example, if you're single, you get taxed at about 10% up to about $11,600. If your taxable income gets up to about $100,000, you could start hitting 24% tax rates. But let's compare this to the long-term capital gains tax rates. Let's scroll down and look at this. If we look at the 2024 long-term capital gains tax rates, if you're single all the way up to $47,000, the long-term capital gains tax rate is 0%. And if you're married filing jointly, you can make up to $94,000 and get a 0% tax rate. So SPYI is a covered call ETF that's more optimized for tax efficiency. So yes, it's very important to do your homework on these covered call ETFs. They're definitely not for everyone, but in my opinion, this is one of the better ones. So there you go, those are 4 of my favorite monthly paying dividend stocks. Go ahead and let me know what you think of these companies in the comments down below. All that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.